mind. This is the little show. The big show is later when I record and I do the video footage of the charts, and we go through trade setups and analysis. The SMH, yeah, that's been just brutal, right? Oh man, that's been a leading indicator too, I think. Yeah, rates and tech. Yeah, look at this. We're definitely going to discuss some of that. I actually was just watching that Kathy Wood interview. I delayed my broadcast to watch that. I wanted to see what she had to say, and I think I have some interesting insights on that. All right, so I think there's I can't tell. It says it's funny, the count of how many people are watching is not always correct. Bank P, yeah, the banks. Yeah, I'm going to talk about that in a minute. They have earnings. JPM I think is tomorrow, and I know mortgage lending is down like 40%. So that's quite a problem. All right, so let's get started. First and foremost, I think there was a lot of confusion today about what was going on in the market, and let me alleviate some of that here. So we had the inflation read, and I think the reason the market initially had rallied was not so much about the actual data that we were presented with, but more of the conditions of the market. We had come into the inflation reading after being down for several days, and you had an underwater close from the prior session, and we had overnight inventory that was short as well. So early on, the squeeze kind of started, and then we ended up right around where we had broken down the prior day, and then that high, or I should say that prior floor intraday yesterday was the high of the day, and then it was just downhill from there. And I think it was a combination of a few things that kind of took down the market. We had oil up was big. That's always problematic whenever there's a big inflation read. And we, on top of the day, we had the crappy inflation number. Now, I know a lot of people are like, oh, it was in line. It could have been worse than expected. It was bad. It was really bad. And I know there are a lot of people who are looking to parse it and say, oh, with X oil and X food and all that. The last time I checked, that's what people use, food and energy. And I criticize the Fed very often for excluding those if they do, and I don't think they're excluding them so much anymore. We also had the bonds were not so much of a factor today. They were kind of tame, but in general, rates have been going up. And that's a little bit of problematic. And I think today, if anything, there was sort of the opportunity for bonds to really bounce given the condition that they've been in, and they didn't really do it. I mean, they kind of just hung in there. I think also one of the big problems, and listen, I signaled this to you guys, those of you who are subscribers to my video service, and even who watched the last broadcast we did, I said that I thought this week in particular was a very difficult one to be long because of a few factors. One, we had the big inflation number coming up. We also have bank earnings, which are going to be potentially problematic. We'll see. And it's going to be tax week. It's pushed till Monday because Friday is Good Friday, and we have a holiday shortened week on top of that, so everyone has to do that kind of selling within a more compressed time. But big stocks like Apple, Google, Amazon, Tesla, these are big dollar stocks that if you have to pay the tax man, it's very easy to liquidate them and take in a lot of money. You just have to liquidate a few shares in some instances. So I think that's been some of the pressure. And I was looking at the breadth yesterday, and it really wasn't all that bad. It was just a lot of these big names were dragging down the market, and that's kind of what got my thesis together of the big stocks being sold to pay taxes. And then I think we saw that today. Although today, at one point, the internals were pretty strong. We actually had an AD line that was over 2100 near the open. That's pretty big. And then to finish basically flattered down is a pretty big drawdown. And then the same thing happened with the, I was looking at the breadth, the visual move was a big decline, but the overall, we still finished up fairly flat in terms of the breadth. So I think it was just sort of a function of market dynamics the last few days. So that's basically what I had wanted to discuss as well. Some of the leading indicators that have had me a little bit more bearish and concerned has been the crash in transports. That JB Hunt in particular, JBHT, keep an eye on that. That's been a big stalwart in the past for the market. CSX is another one I watch. And then the effects of interest rate on big tech. And it's going to be curious to see what happens here after we get through the kind of the tax selling season with some of the big FANG type names, because some of them aren't really high PE multiple stocks anymore. Apple isn't a huge PE multiple stock. Google isn't a PE multiple stock. Facebook isn't a huge PE multiple stock, unless, and here's the big kicker, unless earnings crash. And that's very possible. We could be looking at, Facebook at like 15 or 16 times earnings, and it's really 30 times earnings because, the advertising market dried up. Same thing with Google. Those two in particular happen to benefit from not having huge input costs other than labor, but, there's not a lot of raw materials that go into Google and Facebook and so on and so forth. So those are the kind of things I like to buy in tech in big declines, stocks that have low PE multiples, like Intel, for example. You can see Warren Buffett now was buying Hewlett-Packard. These are old kind of line tech that have low PE multiples. So if you could find things like that, those are sort of the buy the dip stocks. And it's not to say that there aren't conditions that the bigger names can't be bought into, but I'd like to start seeing them making some higher lows and higher highs. So that is a thing of concern. And calendar-wise, we have the buyback blackout as well right now. I mean, it's just sort of, in my experience, and I've been doing this many years, over 25 years. I'm going to be 44 this year. Jeez, it's getting to be a little scary, the age. But this is just a seasonally crappy week, and if you could avoid it, and I talked about this, it's one to try to sidestep. What will happen next week is a whole other conversation, and we'll have to see where we are at the time. It's all kind of price dependent. But, last earnings season, we had very poor market dynamics where stocks that had good earnings had these kind of small pops and then gave them all back right away, and then in some instances, and then some, and then the stocks that missed crashed and kept on crashing. So that's very, very poor risk reward unless, you're only playing on the short side. So longs have to start being rewarded for taking on risk before they will do so in a meaningful way here. So that's sort of my thinking about what's going on with the tape. I think we just have a lot of ducks lined up in a row seasonally, and I want to warn people ahead of time because this is something I think could be coming soon. There's going to be, at some point, some type of resolution of the Ukraine-Russia situation. And I think a lot of people are going to get very excited and get sucked into that rally. But I think that rally is a good one to sell into, because whether it'll last one day or multiple days is yet to be determined. But that's not going to stop the Fed. So we have a increasingly hawkish Fed who's now talking about 0.5 point hikes going forward. So that's my big concern. So that's pretty much all I really wanted to talk about today. This is kind of like a little bit of a mini show before the big show. If you're interested in seeing that, you could. There's a link in my profile. I think I still have the link for the free month if you're interested. If you've never subscribed, you can see my videos free for a month. But that's pretty much what I wanted to cover. Is there anything else anyone wanted to ask me about before we sign off here? And if you missed this or came in late, by the way, you could rewatch it on right here, obviously, on Twitter, or I'll have it both on YouTube and on my Vimeo site. So it's looking like that's it. Semis comment, Taiwan. Oh, yeah, the Taiwan issue also. Although I will comment on the Taiwan issue. I was looking at Taiwan semi versus some of the other ones. It's down a little more, not, I think, markedly enough to say that it's like a proxy. But if there were to be a situation with Taiwan, being invaded by China, that'll obviously cause a lot of problems in the semiconductor land, because that's where, it's sort of like the Silicon Valley over there for that. I think the demand for semis is still pretty high, but if we're going to go into recession, maybe it's going to come down, or maybe margins are going to come down. But yeah, the semis are a leading indicator in my view for NASDAQ, and the fact that they're already pretty much back to the March lows is not a good harbinger of things to come. Unless they got a hold right here, but it's looking a little dicey. That's for sure. Anything else, or are we gonna wrap? I think we could wrap it there. I'm going to grab a bite to eat, and then I'll come back here and film the big show. Link will be posted. Have a great rest of your week. I'll see you soon. Cheers. If I can figure out